Hi, my name is Walter Aylett, and I'm the fund manager for the Nedgroup Bravata Flexible Fund. In the next 30 minutes, hopefully I can give you a quick rundown on over the last year of our activities in the fund. So we'll talk a little bit about performance and where the performance came from and where we had some detraction in the performance of the fund. We'll deal with asset allocation, try and give you a quick view of where the fund is exposed, particularly between the various asset classes. And then more importantly, we'll get into the top equity holdings and the activity that we experienced the last 12 months. It's uncharacteristic. It's been a very busy time for the fund as we've moved between the various asset classes. And finally, we'll just end off with a short outlook on the future. As you are aware, in most cases, we hardly ever talk about what things look like because we don't really know. And we prefer to talk about the investments themselves. So this fun, busy slide, I think what's important about this slide and the performance from inception, which is about 18 years ago, an investment in the fund, you would have basically doubled your money every 6.5 years, which is about 11% per annum. And what's pleasing on the fund, despite some of the detractors of performance, transaction capital hurt us quite a lot, and the fact that we don't have a lot of the momentum stocks which make up the NASDAQ stocks like a Microsoft or a Google or an Apple, the fund still eked out a very good return, beating its benchmark of CPI plus 5 over all periods. And basically, for an investor to get about a 5 to 6% real return over 30 years is nirvana in the pension fund world. And this fund has able to do it with being able to invest anywhere in the world. In terms of a graph, I think what we're trying to say is that it does go through some long periods of underperformance versus CPI plus 5, but this typically is the best time to invest in the fund because our best investment decisions are made in this period of so-called underperformance. And when one looks back, you get the expected return much later as we invest in unpopular stocks, stocks that other investors don't want to invest in. We're actually interested enough in that very same period now, despite the fact that we are beating CPI plus 5. So where did the performance come from? Well, Renette has been a favorite of ours for quite a long period. It essentially is a foreign stock but happens to be listed in South Africa. And there's a very good example of being able to use the mandate of being able to invest anywhere in the world, despite the fact that we've got a foreign company listed in South Africa. Jumbo, a Greek retailer, another favorite of ours that has been around for many, many years, delivered a very good return. We bought this thing around 250 euros. It's now 26 euros. Of course, it's come and gone as it went through the Greek crisis, but continues to develop wonderful new opportunities. Delphi is an Indonesian chocolate company, second generation owned, and as the Indonesians get richer and richer over time, it's the fourth most populous country in the world, over 200 million people, they start moving up the ladder. In other words, they want more expensive chocolate. And then Berkshire, again, a stalwart, a great investment. It's really starting to generate a lot of interest as the cash just keeps on piling into from the insurance business into the company itself. And then a stake in the Aylett Global Fund, which we started 2 years ago. Again, we were quite happy with its performance. To the negative, as transaction capital, we've written extensively about it. And I think what is good to say is that we've managed to recover all our losses, and in effect, all we've lost is opportunity cost. It's lots of profits that we made in the past, we gave back, and now we managed to come back and square off. St. James Place was one we went into early. It's an early investment, and it's not worth really talking about the performance. And Melco, a Chinese casino, has obviously attracted all this negative attention with what's happening in Chinese stocks. It is the only Chinese stock we have, and we expect it to continue to improve as the underlying economics of the business is good. And then Sabre and BAT, again, very similarly, much aligned. People don't want to own these tobacco stocks, and Sabre reservation system. As the international travel picks up, it will benefit. If we look at the fund today, where's the money? If we look at, first of all, equity exposure is about 52% in South Africa. We've got another 26% off local. But what's important in that 25.6 is that Reinet makes up another 8%. On the fixed interest side, we've been very active compared to our 18-year history. And you'll see this for the first time, we're investing in bonds aggressively as well as offshore, as the real returns are being experienced by investors across the globe. And again, we'll talk about that a little bit later. So in all, Bravata is about 65 to 70% offshore. This is probably the most important part of the slide. This is where the money is. As you can see, it hardly ever changes. It's typically of the long-term investing time horizon. We hold shares for more than 10 years. Reinet essentially is a holding company for tobacco, BAT, but more importantly owns a stake in Pension Fund Corp, which ensures the liabilities of pension funds should they wish to pass the risk on to an insurance company. Berkshire itself continues to deliver under Mr. Buffett now that Mr. Munger's passed away. And it will be quite interesting to see as his two lieutenants come through and start assisting him. BBW or Bath and Body Works, very exciting as the consumers is still very strong in the US. And what we're excited about is what they're introducing to new products, whereas before they were a candle and fragrance business, men's health, men's cosmetics, and new cosmetics for females is starting to play an important part in their top line. Spoken about Delphi, a wonderful chocolate company in Indonesia. Hopefully one day someone like Nestle or Lindt would love to buy them. ACI, our first South African company in a big way. Great chemical company, explosives business. Got a new CEO, and we expect him to divest of a lot of their non-core businesses and stay focused as the biggest explosive stroke chemical business in South Africa. Ruby is a wonderful also a family-owned business in France, and essentially we know it as Easy Gas in South Africa. We've got the Caribbean, we've got East Africa, and then a bit of Europe. BAT, again, most of these stocks, the investors for ESG concerns and believing that the business is in complete decline that will not exist in 10 years. We obviously disagree. We still like BAT quite a lot. Jumbo I've spoken about. And then SBM Offshore is, just imagine that these big floating platforms sitting over very deep sea exploration to oil underneath there and then delivering the fuel up to the floating platforms. There are only two in the world that make these things. SBM Offshore is a Dutch company. The divi yields between 5 to 7% in euros. So what have we been doing? So for the last year, we've started investing in 3 new companies. Dollar General, which is a discount retailer in the States. St. James Place is a financial advisory business in the UK. And Heineken Holding, which was disappointed on Asian earnings, mainly Vietnam. And we thought that was a bit much, and we started adding. On the sales side, which is uncharacteristic of us, we sold a Mexican airport, 14 airports in fact, very good investment. I think we generated almost 100% on that returning. Bookingholdings.com, you'll know as well, we made good money. Sonic, Hess, all of these shares generate returns between 50 to 80%. Meta, which is better known as Facebook, we obviously exited a bit too early, but we made some money there. And US Bank Corp was a decision to have no banking exposure in the States. So if we look at the fund, where's the most action in terms of down weighting, you can see we moved out of the long duration bonds, which is on the higher risk side, into much shorter duration, but the 2 to 3 year money. Reinet, we took some profits as it did very well. And Tsogo-san, we decided to reduce our exposure there and move that money into transaction capital, which was a good investment so far. In other words, we were able to buy it in TC in the low 4s, 5s, and so it's 750 today. The rest doesn't really matter on the down weights. On the buy side, again, adding new stocks like Coca-Cola, much of a defensive type play. 91 an asset manager in South Africa, and ConocoPhillips. As the oil price came down, we added to Conoco because we believe it's the best oil company to invest in. And then into weakness, Victoria's Secrets, Ruby, and BAT. So as we look forward, this is kind of what dominates our thinking at the moment. Local assets are cheap on any measure. So we know that most all assets, be it bonds, properties, local equities, on price to book, PE relatives, past history, PE to growth, they're cheap. So many of the foreigners and local fund managers have taken the full capacity offshore. In other words, locals have taken 45% of their asset allocation in the pension funds offshore. And most foreign fund managers have reduced their exposure to South Africa for the last 5 years. So any change of any positive nature will create such a short supply that they will have to come back. And we're hoping that South African assets, which we know cheap, will attract back this money. In the meantime, we are buying companies that we understand very, very well, which to our mind have long-term prospects in this country, despite the fact the negative news that persists in South Africa. And as they are taking market share from their competitors, come the time when our futures, our prospects change for the positive, these companies will do very, very well. So what could change it? We all know that electricity problem is being solved by private enterprise. In other words, we all have our own electricity. There's about 5 gigawatts that's come on solar in the last 2 years. That's 5 stages of electricity supplied by Eskom. And just like we had a water crisis 4 or 5 years ago in the Western Cape, we think we're quite resilient and we'll come back. It doesn't take much to fix the problems in South Africa. There's potentially a lot that can be fixed very fast. Finally, if you look at the yield of the fund, it's very high from a dividend yield and a fixed interest point of view. Our fixed interest earns about 9 to 10% local and offshore 5% plus in hard currency. So should we have some disappointment in the equity markets, we'll have a buffer in terms of income yield on the portfolio. So in conclusion, we think Bravata is wonderfully well placed to take advantage of any weakness in the market. We have tons of cash. We know what we want to invest in. We're waiting for any weakness. And should we not see any weakness, the fund will keep up at least to 2/3 to 75% of most performance in any asset class, with the exception of maybe the NASDAQ.